terminologies. As you can see, so let's go. So, like I said in the previous videos, there are a lot of things you need to know. There are some things you need to know in the forex market. There are some things that are necessary for you to know. You understand? There are things that is necessary for you to know in every field. There are some basic things you should know. This forex terminologies is one of the most important basic things you should know in forex, because it's one of the most common things they use daily in forex trading. Yeah, and I will be putting you guys through every move of these forex terms. So let's go. We have number one, we have up to 20 of them or even more. But as time goes on, you know them, but I'll be breaking down these 20 of them, the one that are the most important ones that I have here. I'll be breaking it down for you guys. I'll be breaking it down for you guys to your understanding. Okay, so you should pay close attention. And also, if I were you, I will bring out my notepad or a jotter whereby you jot the ones you can get. Yeah, like you jot the ones what you see or maybe what you understand that I'm saying. So let's go to number one. We have currency pair. You see, what is currency pair? The currency pair is a quotation of one currency against another. Currency pair. A currency pair is a way two different currency are quoted when traded in the forex market. They are the two currency pairs that are quoted when trading the forex markets. Currency pair are those two currencies from two different countries. You can't trade the forex without currency pairs. There must be two currency pairs. You can't trade only one currency, but there must be two major currency pairs before you'll be able to trade forex. So currency pairs is the number one, which is, for instance, we have Euro USD, AUD USD. We have a lot of currencies. So currency pair, it shows how much of one currency you need to buy. It shows how much of one currency you need to buy 1 unit of another currency. It shows how much of one currency you need to buy. You need to buy 1 unit of the other currency. So like what you can see here, example, Euro USD equals to 1.0850, means 1 euro is worth up to 1.0850 US dollars. You can see that. So that is normally, in the normal terms, euro is always a little bit higher than dollar, which every one of us know that. So the currency, the first currency is the base and the second is the quote currency, which you can see here. The euro is the base currency and the USD is the quoted currency, which I'll be explaining also. So for instance, the first currency is called the base currency. The first currency you see here, let's say for instance, for example, the first currency is Euro USD. The euro here is the base currency, while the USD here is the quote currency. So the euro is the base currency, while the USD is the quote currency. Euro base currency, USD quote currency. So when you trade Euro USD, you are buying euro or selling US dollars. You are either buying euro or selling US dollars. So that is how it works. So let's go to number two. Quickly go to number two, which is the base currency. What base currency is? You can see it there, like I explained, like I said previously. I said base currency is the first currency in a pair. Base currency is the first currency in a pair. The currency that comes first. It can be USD JPY, it can be GBP USD, or as far as it comes first, it's called the base currency. As you can see here, the example in GBP USD, the GBP is the base currency, which is the first one before the USD. That is the base currency. We call it the base currency. The first currency before the next one is called the base currency. So the base currency is the currency in is the first currency in the currency pair. It shows the value of 1 unit that it shows the value of 1 unit of that currency. It shows the value of 1 unit of that currency compared to the other quote currency. So let's go to the quote currency, which is the third one we have here. We call it quote currency, or we also call it counter currency. So the quote currency is the second currency in a pair. It shows the value of 1 unit of the base currency. Quote currency shows the quote currency shows the value of 1 unit of the base currency. The quote currency, it shows how much of that currency is needed to buy 1 unit of base currency. For instance, if you have Euro USD, if you have Euro USD, if you have, okay, let me use the GP. If you have GBP USD, the second is the quote currency, which is the USD. The second is the quote currency, which is the USD. And like I said, the GBP is a base currency, and the USD is a quote currency. The one that comes first, the base currency, and the second one, quote currency. You can see that slash that divided both currency. The first one that came first, which is this GBP, is the base currency, and the USD is the quote currency. So that is how it works. So let's go further. So we also have the bid and ask. The bid and ask. So I know most of us might have known what bid and ask is maybe before now, but I will explain it more for us to be able to understand how it works in the forex market. So you see, the bid is the project, it is the price at which you sell the base currency. Bid is the price at which you sell the base currency. Bid price is the price you can sell a currency pair. Is the price you can sell a currency pair. While the ask price is the price you can buy a currency pair. The ask price is the price at which you can buy the base currency. That is the ask price. Is the price whereby you can buy the base currency. So we have, for example, we have if Euro USD equals to 1.0848, yeah, slash 1.0850. The bid price, sorry, the bid price, which is the sell price, the bid price, which is the sell price, is 1.0848, while the ask price, which is the buying price, is 1.0850. The difference between this 50 and this 48 and 50 is spread. They are just 2 pips different, which is a spread, which I will explain about, which I will tell you guys about. The difference between this bid price and ask price is spread. What is spread? What is spread? So the spread is the difference between the bid and ask price. Spread is the difference between the bid and the ask price. It's the brokers profit. That is the profit they make. Those brokers that we use, those brokers that you and I uses, those are the profit they make. Those little spread. Yeah, I know a lot of brokers has a larger spread and all that, but the minimum spread a broker should have is minimum of 2 spread. That is why in times of when you're choosing a broker, a lot of people always consider spread. If that broker has a wide spread, most people don't even use it. Most people don't go about using them. Also me, I don't use broker that has a wide spread. Yeah, because they easily manipulate just to make money out of people. So at least you should go for a broker that has at least minimum of 2 pips spread, because that is their commission if they are not greedy enough. Yeah, some brokers are very, very greedy. They take more than 2 pips. So the difference between bid and ask price, this buy and sell price, is spread. Spread. So that is how we came about the spread of a thing. So the difference between bid and ask price is spread, and spread is the broker's profit. Is the profit that the brokers makes from every execution, from every trade we take, but for on every trade, on every single trade they have spread on every single trade, and those spread, those are where they make money from. Those are where they make money from. Yeah. So let's go forward. We have pips. We also call it percentage in points. Percentage in point. What is pips? So what is pips? You can say in Forex, pips stands for the percentage in point or a price interest point. Is the smallest price movement a currency pair can make, usually the fourth decimal place. A pips, a pip. If Euro USD moves from 1.0850 to 1.051, that means it moves 1 pips. That means Euro USD moves just 1 pips. So if you can see clearly, the difference between what happens there is just one pips. The market only move 1 pips. That is why we get 1.0851. The market just moved just 1 pip. That is why we got this 51 here, and here is 50. This was the buying price. This was the buying price. At the buying price was at 1.0850, and you sell at 1.0851, that you make profit of 1 pips. You make profit of 1 pips. So that is what pips is. That's actually what pips is. So pips is basically mainly used in pips is basically used in calculating how the market move. How the market move. Like every day, you can, as a trader, you can predict that maybe you want to catch up to 100 pips from the market today, or you want to catch up to 50 pips, or you want to catch up to 30 pips from the market. So you calculate every move of the market by pips, depending on the lot size you are using, which is the next one we'll be talking about. So it depends on how many pips you want to gain a day. Yeah, there are some people that they has a trade management like that says they want to make 100 pips every day. They want to make 50 pips every day. They want to make 30 pips. Or on a single trade, you can decide to put your take profit or stop loss at 50 pips. So every calculation in the forex market, this actually goes around with pips. You actually have to, if you want to calculate anything in forex, on how to take your profits or how to set your stop loss, you have to calculate it in pips. You have to do it in pips, and it's usually the fourth decimal place. You can see it there, or usually the fourth decimal place. If you can see, it's well explanatory. So we go to the next one, which is the lot size. See, definition of lot size. Okay, let me tell you guys a brief stuff why pips matters in forex. Pips helps trader measure profit and losses. Pips helps traders measure their profits and losses. The number of pips gained or lost multiplied by lot size tells you how much you made or you lose. The numbers of pips gained or lost multiplied by lot size tells you how much you made or lost. So pips is very, very important to know how to calculate your pips. It's very, 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 very important to know how to calculate your pips. So you can see here, but there are some currency pairs. There are some currency pairs. There are some currency pairs that their pips, in terms of calculating their pips, is a little bit different. But in terms of Euro USD and other of these currency pairs, in terms of calculating, is the fourth decimal place. That is how you calculate pips on this Euro USD, GBP USD, and other currency pairs, other currency that comes with USD. They always usually the fourth decimal place number. Like you can see here, 1.0850 to 1.0851. So the fourth decimal place, which is the 1 pips different. So let's go to lot size. You say a lot is this. So let's go to lot size. What is lot size? Lot size in Forex is a number of units of the base currency you are trading. It tells you how big or small your trade is, and it directly offers how much money you can make or you can lose per pips movement. That is all about lot size. We now have the standard lot size, we have the mini lot size, we have the micro lot size. So lot size, for instance, lot size is something that if you want to trade, you have to decide on. I think that is the first thing after making your analysis and you want to execute your trade. That is the first thing you have to decide on. Which lot size am I using? Now, you're using lot size depending on the kind of account size you have. You might be having a $10,000 account. You can be having a $1,000 account, a $500 account. You can't use any kind of lot size on any of those accounts. Yeah, it's possible you can use it on those accounts, but there is a higher probability of you losing a lot of money when you use a very big lot size on a smaller account. There is a higher probability that you're going to blow off the account, except you have a lot of experience in the market. Then you can go ahead and do that. But if you don't have a lot of experience, you're a newbie, like every one of you, you don't have to use the standard lot. Like you can see, the standard lot controls 100 units of the base currency. You can see it there. So the 100 lot, the standard lot, which is the standard lot controls 100 units of base currency. 100 units. So a standard lot equals to 100,000 units of the base currency, which 1 pips equals to $10. If you're using a standard lot, just 1 pip movement will give you $10. 1 pip movement will give you $10. So this standard lot can actually make you a lot of money. That is why I said lot size can make you a lot of money and can also blow off your account. Especially when you're trading in a volatile market or a pair that moves very fast. Just something like gold, you using a standard lot on gold and a smaller account. It won't take any time. In fact, in less than 5 minutes, it can blow off the whole of your account. So that is how lot size is. So if you're using the standard lot, 1 pips of this standard lot is about $10. You're making $10 on every pips, on every move on a standard lot. When you're using a standard lot, you're making $10 on every move. On every single move, you're making $10. So you can see how much it is, how fast it is. So just imagine you are using a standard lot and you are able to make or catch up to 30 pips. You can see how much is there. So $10 times 30. So you know how much is there. And there are some trade you can take that can give you up to 50 pips, 70, especially on gold, can give you up to 50, 70, 100 pips in just a matter of no time. So secondly, we have the mini lot, which controls 10,000 units of the base currency. Controls 10,000 units of the base currency. So these account sizes, these account sizes, it simply means if you can't go for the standard lot, you can go for the mini lot. If you can't go for the mini lot, you can go for the micro, depending on how much you have, how much account size you have. Depending on how much account size you have. So the mini lot is equals to 10,000 units, which is 1 pips per move. 1 pips per move is equals to $1. 1 pips per move on the mini lot is equals to $1. So every pips the market gives to you on this mini lot gives you $1. On every pips gives you $1. You can see how it is. The higher it is, the higher money you make, and the lower it is, the lower money you make. But you have to go for the one that won't actually wipe off your account. You have to play it safe. You don't have to say, hey, maybe I want to make quick money, I want to make this money. Or you are seeing a lot of people, a lot of big guys using bigger lot size, using standard lots. There are some guys that use 100 lots. I know what it is. Just one move. You're using 100 lot size. One move is giving you $100 on that 100 lot size, which is one of the which is this in a category of this standard accounts. One move of that 100 lot gives you $100. One move gives you $100. So it depends on the account size you have. So this mini lot, it gives you $1 per pips. Every pips the market moves gives you $1. Every pips the market moves gives you $1. So the last but not the least on here, on the lot size, we have the micro lot, which is about 1,000 units of the base currency. 1,000 units. So you're controlling 1,000 units of the base currency. So micro lot is equals to 1,000 units, which is 1 pips is equals to $0.10. 1 pips of the micro is equals to $0.10 you make per pips. Pips. So I always advise everybody, like a beginner, should always go for this micro or the mini lot, but don't go for standard yet. If you're not advanced in the trading aspect, if you're not advanced in trading, don't go for standard. You have to know what trading is. You have to make sure you have your psychology in the right states, and so that when you're trading or whenever you make your analysis, you won't be you won't be scared of what you want to do. You just pick your trade with boldness, with confidence, without even having any fear. But if you're not experienced enough, you can't be using a standard lot size. You have to train yourself to that extent that you can be using a standard lot size. So that is how it is. So I always advise all beginners should be using micro. Micro is way more easier, and it gives you the less this thing to blow off your accounts. Understand? The percentage of you blowing your account is always very low when you're using a micro account. Your percentage of you blowing off your account is very low. So you don't have to be leveraging more whenever you're trading as a newbie. Just use a smaller lot size. You can use 0.02, 0.01, and most especially when you're trading gold. If you want to be trading metal, you can be trading using a lot size of 0.01, 0.02, and all that. So that is what lot size actually means. So let's go to the next one, which is called leverage. So what is leverage? As you can see, borrowed money from your broker to control a larger trade size. So leverage in Forex means you can control a large trade with a small amount of money. You can actually control a large trade with a small amount of money. Leverage is what your broker gives to you. Yeah. It's one of the benefits of you using a brokerage account. They give you the leverage of trading big with a bigger in a big way. If you actually know what you're doing, you can leverage and make a lot of money. Understand? So for example, one to 100 leverage means you can control up to $100,000 worth of base currency with only $1,000 of your own. You can control an account and you can trade up to like that. Just you having a $1,000 balance, you can leverage as if you have up to $100,000 on your account with just $1,000 balance on your trading account. You can leverage as if you have up to $100,000 on your account. So, but also this leverage also helps you you can make more profit, yeah, quick profit and more profit whenever you leverage like that. And it also amplifies both profit and losses. You can see leverage also amplifies both profit and losses. So you leveraging more higher can also bring to your big loss or also your big win in the forex market. So you have to mind how you leverage when you're trading. You always have to be very conservative and always play it slow and steady. Don't always force yourself to the market. Maybe you're trying to make more quick money because you see all your friends are making a whole lot of money, making $1,000 every day or every week. You want to be like them, blah 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 blah. Then you want to leverage so you can make money fast. It doesn't work that way. It doesn't work that way because if you don't know what you're doing in the market and you leverage higher, it will just sweep off your account if price goes against you. If price goes against what you're doing, it will definitely sweep out everything you have on your trading account. So that is what leverage actually means. Then the next one we have, which is number 9, we have the margin. The margin is the amount of money you have in your trading account to open a trade. Leverage margin is the amount of money you must have. Is the amount of money you must have. Leverage is the amount of money you must have on your trading account for you to be able to open trade. With a 1 to 100 leverage to open a $10,000 account, you need a what? $100 margin, which is $100 deposit. You need that $100 deposit for you to leverage up to $10,000. You need a $100 deposit for you to be trading as if you have a $10,000 account. You need that $100 deposit on your account, which is $100 margin. So this is not much important, but it's still not that important, but you have to also know what margin is. One that is more of important is the margin call, which we'll be going for, which is number 10. The margin call is a broker warning that your account equity is too low to maintain open position. You may need to deposit more funds or your trade may be closed. This margin call is actually what I think every trader experience this margin call. There's no trader that can tell me that he hasn't experienced what margin call is. Margin call is something you experience as a trader. Is a must. Is a must. At least 99% of all traders experience margin call. So what is margin call? Margin call is a situation whereby you're trading and you forget to put your stop loss. I'll come to that. Yeah, we also have stop loss. I will explain what stop loss and take profit is later. It's also down here. So margin call is a process whereby you forget, or maybe you were trusting on your analysis, believing price will be buying, and suddenly price went against you. Price went against you, and maybe you didn't put your SL, which is your take profit, to stop you out. Maybe when price goes against you, you didn't put your stop loss. So the price will just keep on dipping down, and that is how your money is going. Maybe you had a $1,000 on your account. You have a $1,000 on your account, and the trade you took went against you. The trade you took went against you. That $100 or that $1,000, the moment your money gets to 900 minus 900, the broker will call you directly, will call you on the phone. Yeah, it's automated. The broker will call you on the phone telling you to go and close down all your trade, or it's for you to go and close down all your trade, or you should go and put more funds in your trading account. So that is what margin call is. So whenever you are having a shortage or whenever your account is about to be wiped off, the broker will call you to notify you to go and add more funds. If truly you believe this market will be going, it will still go in your favor, you should go and add more money to the account so that it won't go out, or you just close down all the trade. So that is what margin call actually is. That take us to equity, which is number 11. What is equity? You say equity in Forex is the total value of your trading account right now, the total value of your trading account, including your profits, your loss from open trades. Combine everything together is your equity, your total balance and everything. Both your running profits, your losses and everything. That is what your equity is. So equity, like I said, in Forex is the total value of your trading account right now, including your profit or your loss from open trades. So equity equals to balance plus floating profit and losses. So add everything together is equals to equity. That is what equity is. So equity, you add everything you have on your trading account, maybe your balance, because if you go to your MT5, you see where they have. Hold on, you see if you go to your MT5, you see where they have balance, equity, margin, free margin, and margin level. So your balance and your equity combined together, your balance and the running position of your trade running, both the profit and loss is equals to your equity. That is your equity. So, and also balance, which is number 12. Balance is just what you have on your account. Yes, balance. There's difference between equity and balance. Equity is you calculating the total sum of both your profit, your loss, and everything you have on your account. That is what equity is. Then balance, for instance, if you made a deposit of about $100. Okay, let me say you made a deposit of sorry. Let me say you made a deposit of about $1,000. You made a deposit of about $1,000 and you open a running position. Maybe you're in a profit of about $300, and some other trade you are losing up to $100 or $50. Your balance will still remain as $1,000, which is the initial deposit that you made before opening those trade. It still remains your $1,000, even if you're in profit of about $400 to $500. Your balance still remains $1,000, which was the money you deposited before. So your balance remain as $1,000. So the only time you can add or remove is only when your running trade has been closed. Maybe your running trade closed in profit or in loss. But if it closed in profit, for instance, then what you deposited was 1,000, which is your initial balance. And maybe you placed a trade, and at the end of the trade, you were able to make up to $500. Then you can say your balance is now $500. But that will be after when your trade is closed. That is your total balance. That is your total balance. You add the money you made, not when the trade is still running. They won't calculate that to it. But if you lose the trade, if you lose, let me say for instance, if you lose 500 on that account, it's going to be $500 balance remaining. $500 balance remaining. But if you win the trade, or if the trade goes in your favor, then you made up to $500. It will be plus 500, which is 1,500 balance. So that is what balance means. So let's go to stop loss, take profits. Stop loss and take profit. What is stop loss? So what is stop loss? A stop loss is a preset price level where your trade automatically close or close to limit losses. So a stop loss, which is also known as SL, most people call it SL. Yeah, we do call it that. A lot of people call it SL, which is known as stop loss. If you're it simply means if you're trading, if you want to open a position, or maybe you go to the market, you make your analysis. After making your analysis and you saw that maybe the Euro USD wants to buy, then you just execute your trade. After executing your trade, one thing you have to look at first, one thing you have to take care of first is SL, because it limits you from blowing off your account. It protects your account. It protects your money. Because if market goes against you, maybe if you take a trade, then the market goes against you, you can decide to risk on every trade. You can decide to, okay, let me say, for instance, you have a $1,000 balance dollar account. You have a $1,000 trading account, and on that $1,000 trading account, you want to be risking $100 on every trade you take. You want to risk $100 to make up to $300. So let me say you're setting your stop loss at $100. So now that $100 means if this market goes against me, I want $100 to be gone, and the other $900 that is there to be protected. I want $100 to be gone and the other $900 there to be protected. So that is what stop loss means. So whenever you place the trade and leave it to run, and the price market goes against you, you're only going to lose $100. That is the work of stop loss. You are only going to lose $100. It works automatically. The moment you set it, it works. Even if you're not there, the moment price goes against you and come back to that your stop loss, it will take out the exact amount of money you wanted it to take out. That is why it's always very, very necessary for you to apply risk management whenever you're trading. Always very necessary for you to do that. Always apply a good risk management whenever you're trading. So using stop loss is one of the best things. It's something you shouldn't even forget, because if you forget using your stop loss, it can wipe away your whole account. If market goes against you, your whole account can be wiped off. The whole of your account can be wiped off by you forgetting to put your stop loss. Because even if you have a $100,000 account or a $1,000 account, and maybe price goes against you, it will wipe everything out, because there's nothing to hold it, nothing to hold the price. You didn't set anything to hold the price. So it will wipe everything off your account. So for you to play safe, for you to be safe, or for you to protect your capital, because one thing about trading, I always tell people that are close to me that capital preservation is number one thing we have to always do whenever you're trading. Preserve your capital. Know your risk appetite. If you want to go on a trade and you see that, okay, this is what I'll be able to risk on this trade, this is what I'm good at to risk on this trade, I'm good at risking $10 on each trade. Okay, let me risk this $10. So if market goes against you and hit your $10 stop loss, it will still be okay. If it goes in your favor, lucky you. So that is actually what stop loss means. And take profit is opposite. It's same thing. A preset price where your trade automatically close to secure your profits. Maybe you want to take your profit at 30 pips. Like I said, if you're risking $100 to make $300, whenever price is up to that level, whenever price is close to that up to that $300 you set, that okay, make price should automatically close or secured my profits whenever it's up to $300. The moment price get to $300, it will close the trade automatically for you, even when you're not there. It's close. So similar thing like stop loss. So stop loss is the losing side, and while take profit is the one the preset price level whereby you set for your profit to be secured. So 15, we have the other types. I want to be very, very brief. After this, I will also be giving a PDF that explains all these things. So you can also go through the PDF, and I will advise you to always go on this video again and again and again, so you can understand everything I said in here. Yeah, I know I might not be that good at this moment, but I believe I'm trying my best. I'm doing my best to put out this here so you can understand. I'm trying my best to break it to your understanding as well. You know, this is my first time doing this. Like I said in the previous video, this is my first time of doing this, so you have to bear with me and take me the way you see, and try to understand how I'm going about it. So let's go to number 15, which is the limit order types. We have order types. We have in order type we have market order and we have pending order. Market order simply means execute immediately at the current price. Market order simply means you execute, you buy or sell at the current market price. You don't have to set any limit order. You don't have to set any pending order. You execute the moment you see your setup. You just execute your trade. That is what we call market order. You execute it immediately. Immediately. Then the pending order we have, depending order, you execute it later when price reach a specific level. We have in pending order, we have buy limit, we have sell limit, we have buy stop, we have sell stop. So now, pending orders, we have buy limit. So let me talk about this buy limit. So what is buy limit? Or let's say for most people that does 9 to 5 and also trade forex per time, there are people that mainly use all these pending orders. Yeah, or maybe if you want to go to somewhere and you won't be on your system, you won't be on seat, it's always advisable you use a pending order, because even when you're not there, your broker will help you execute the trade. It's just for you to give instruction that when price get to this certain level, execute my trigger, let my trade be triggered. So limit order, you set is in limit order, which is the limit order, like I said, yeah, a buy limit. Let me say, for instance, a buy limit. You set a specific price you want to buy or sell at, you want to buy at, and trade opens only when price reach to that level. You set a price whereby, for instance, you want to buy at a certain level and price is still upward, and you want that market to retrace down a little bit before buying. You just set your price, you just set the price, you just set your limit order below the price, you just set your limit order below it, and whenever market retraces to that zone, to that level where you set your limit order, your buy limit, it will trigger you into the market even when you're not there, as far you set your buy limit that if this market retrace from up, retrace back down to this zone, I want to be triggered in this trade. It will do it. Your broker will help you do that. That is the work of your broker. It helps you do that automatically, even when you're not there. As far you already give the instruction of if price comes to this zone, make sure you take my trade. It will do that exactly for you. Similar thing to sell limits. Maybe price is going down and you still believe price will retrace back up a little bit before selling down. You just have to put your sell limit above so that whenever price retraces back to that your sell limit, it can start selling off from there, and you come and see your trade in profit. Or maybe if it goes against you as well, you also see it in loss. So we also have buy stop and sell stop. Buy stop and sell stop. Buy stop order, you set a price above or below the current market level to trigger a trade when price break that point. To trigger a trade when price break that point. So this buy order, this buy stop, let me say you have a resistance up there and you just don't want to go into the trade. You have a resistance up there, you just don't want to go into the trade, and you want market to break that resistance. After breaking that resistance, retest before it will start buying off. If that is what you want, then you just have to set your buy stop at the top of the market, so that whenever price comes to that side, it will just trigger you into the trade and keep on going. Mainly, I mainly use this buy stop on during news, maybe during NFPs and all that. If it's during NFP, then I know that the market is bullish and I know that it will still buy, and I know that that day is a buy. The market is a buy that for that day. I will just set my buy stop so that when the market is going up, it will just kick me in and go direct. So that is what buy stop means. And also similar thing to sell stop. If you're predicting that maybe price will sell, if you're predicting that the price will sell, whenever the price get to your order, it will trigger it immediately, and you'll be in profit or in loss. If you did it right, your result will show if you did it right or you did it wrong. You made the wrong analysis or the right analysis. So it's as simple as that. So we have long position and short position. You can see when people say I want to go long on Euro USD or I want to go short on Euro USD. So whenever you hear somebody saying, a forex trader saying I want to go long on Euro USD, that means the person is expecting that currency to buy. Is expecting that currency pair to rise. So long means buy and short means sell. So whenever somebody say, Alpha bro, I want to short this particular currency, I want to short XUD, XUA, USD. I want to short gold. I want to short USD JPY. They're trying to say they want to sell those currency pairs. Understands? All these things that I'm talking about, it also works in the crypto market. If you're also a crypto trader, all these things works in the crypto market. All these forex terminologies, they all works in the crypto market. They have limit. They also have limit order. Yeah, they have limit order. They have buy stop. They have all those features in uh crypto as well. So buy, long, and short sell. So whenever it's long, whenever they say I want to go long on a particular currency, it actually means they are expecting the currency pairs to rise. Then whenever they say I want to go short on this particular currency, that means they are expecting the currency pairs to fall. So the next one up there is volatility. Volatility. Yeah, volatility. So what is volatility? Volatility is how much and how quickly price moves. Volatility is how much and how quickly price moves. So that is what volatility is. So volatility, sorry guys. Volatility simply means how much and how fast the price of a market can move over a certain period of time. It means how much and how fast the price of a market can move over a certain period of time. We have low and high volatility. We have low and high volatility. We have high volatility. Price move up and down quickly by a large amount of markets, and is more risky. Whenever we have a high volatility, it's more risky. So this high volatility, it always happen in some sections. We know in Forex, we have different sections. We have the London section, we have the Asian section, we have the Frankfurt section, we have the New York section. But the three basic section people knows and which people use mainly is the Asian section, the London, and the New York sections. So high volatility mainly happens during the London section and the New York section. That is when you see a high volatility of the of markets whenever is any of those sections, because those are the time you can see the big bands coming into the market. You can see the big guys that has a lot of money. The people that has a lot of money are coming into the market. So then you see volatility. You see market moving very fast and quickly. Like if you want to try what I'm saying, if you're doubting it, maybe during New York section or London. Okay, let me say during London, New York section, you can go and check your chart. Just pay close attention to the chart and see what the chart will be doing. It will be going up and down, up and down, up and down, because there is high liquidity volatility in the market. There are a lot of people in the market buying and selling currency pairs and all those, So there's always high volatility in those sections, in the London section and the New York section. Then we have a low volatility. That means there is not much movement in the market, which is during Asian, and most people don't even trade during that Asian because of the low volatility. Because market will just be consolidating, ranging. Market only moves whenever it gets to London section and New York section. That is where you see market price moving faster, and it will give you what you want. So most people, I think majority of people trade during the London and the New York section. They don't trade during the Asian section, because the Asian section is the low volatility. Is the time whereby the market consolidates, have a little, breathe a little. Yeah. The market also breathes. Those are the moment that the market breathes. So if you trade whenever the market is breathing, it can lead to a lot of losses also. You can lose a lot of money. It's also risky. The higher volatility is also risky. The lower one is also risky. So you just have to be careful and play safe. But I always advise during the higher volatility, which is in London section and the New York section. So the next one we have here, we have liquidity. We have liquidity. I don't want to take us that long on this particular class. I just want to be very fast, so we can round up on time. So we have liquidity. What is liquidity? I know most of us might know what liquidity actually means. You may be asking, what is liquidity? Say liquidity is how much money buyers and sellers is flowing in the market. Liquidity is how much money buyers and sellers is flowing in the market. Liquidity in Forex means how easily and how quickly money or a currency pair can be bought or sold without changing its price too much. It simply means it shows you how many buyers and sellers in the market. Liquidity. Whenever you see a big bullish candlestick, I know most of you don't know candlestick, we'll come about that as well. I'll also drop a PDF that teaches about candlestick. Whenever you see a big momentum, big pressure of sellers coming into the market, you know that there is a lot of liquidity in the market. You know that the buyers are much. And also we also have some pairs. We also have some pairs that are that has high liquidities, which are, you can see majorly the currency pairs that has USD on them. They have the Euro USD, the USD JPY, and all those currencies. They have high liquidity. They run faster. They go faster. Understand? They go faster, and those are the currency people trade most. The currency that has high liquidity. Those are the currency that can make you quick, that can make you much money. Whenever you trade a currency pair that has high liquidity, you don't go for all those pairs that doesn't have any liquidity. You go to pairs that has high liquidity. Like me, I trade gold. I trade more of gold. So gold is very, very volatile. You can know that. Anybody that knows that knows. Gold is very, very volatile. So gold is also has a high liquidity. Though gold is not a currency pair, gold is a metal. So gold is also something that has a high liquidity. So people mainly go for those currency pairs or metals that has high liquidities. So high liquidity are many buyers, many buyers and sellers in the market, common in major currency pairs. They are mostly in major currency pairs in Forex, like the Euro USD, GBP USD, USD JPY, and etc. During the London and the New York session, the market is very liquid. Market always moves very fast, just like I said in the volatility. During the London and New York section, the market always moves fast on all these pairs that has high liquidities. Markets always move fast and smoothly in order to feed easily. Understand? Then we have low liquidity. Low liquidity, we have few buyers, sellers, trade take long to execute. It takes long for your trade to move up to 10 pips whenever they have low liquidity in the market. Maybe during the, like I said, during the Asian section, there is always low liquidity during that section. Or there are some pairs that doesn't really move at all. There are some pairs that doesn't move at all. They have low liquidities. Those pairs are not advisable to trade. You don't have to trade those pairs. Just go for any of these major currencies, which are USDJ, like I mentioned them. You can go back and rewatch, or you can make research about them. These major currencies, those are the currencies you should be trading. Those major currencies are the currencies you should be trading. So we are going to be able, I'll be teaching you guys, we are going to be looking at what are the major currencies. We have major currencies, we have minor currency, we have exotic current pairs. Those are the currency pairs we should be trading. We have major currency, minor, and exotic pairs. The major pairs, those are the most traded currency pair in the world. The major pairs are the most traded currency pairs in the world. They all include USD. You can see, for instance, we have Euro USD, GBP USD. We have USD JPY, USD CHF, we have AUD USD, NZD USD, USD CAD. Those are all major currencies. Those major currencies are those currencies whereby are from a good developing country that they have a very good economy and the economy is moving very well. So those pairs are the pairs you should be trading. Those pairs are the pairs that has liquidity. You should be trading. It has a very good liquidity that whenever you go to the market, at least it moves off to 100 to 200 pips daily. All these pairs move off to 100 to 200 pips daily. But there are some pairs that doesn't even move off to 50 pips daily, just like the exotic pairs. Some of those exotic pairs, they don't even move off to 20 pips a day. So you shouldn't be trading pairs like that. You should be trading pairs that moves faster. So we have the minor pairs. They don't include USDs. The minor pairs, they don't include USDs. Example, we have Euro, GBP. We have the minor pairs. Those pairs don't include USD, but involve other major currencies. We have Euro GBP, we have Euro JPY, we have GBP JPY, we have AUD NZD. They don't include USD. They don't include the US dollars. So those are the minor pairs. They don't include US dollars. They don't include USD. So also we have the exotic pairs, which is one major currency plus one developed currency. So the exotic pairs, those are a major currency with a currency from a similar or a developing country. Example, the exotic currency, people don't even trade that. I don't think people trade that. They don't trade that. I've never traded any of these exotic pairs before. Never traded that. You can see we have USD NGN, which is the US dollar versus Naira. If you want to try it, you can go on the chart, you can go to your trading view, or you can go to anything you can use in viewing the chart and see how USD and NGN, which is Nigerian currency, is doing. You can't trade it. There's nothing to trade about it because the dollar has more power than the Naira. And it is not an economy that moves like it's not a good working economy. So people don't mainly trade that. People don't mainly trade that. So it has lower liquidity, higher spread, and more of volatile. It has lower liquidity. So it's not something you should even think about. It's not something you should think about trading. The exotic pairs, it's not something you should think about trading. Yeah. So I always advise you should go for major currency pairs, and sometimes I do trade minor pairs also. I do trade Euro JPY. I do trade one of my favorite pairs on these minor pairs is Euro JPY. Euro JPY, one of my favorite pairs. Euro JPY. So we also have the last but not the least we have here is the fundamental. We have fundamental analysis. Fundamental analysis we have fundamental and technical analysis, which is the main thing. Which is the main thing about in Forex that you have to know. You need to know about fundamental a little bit, even if you don't want to go much deeply into fundamental, you need to know about it. And you also need to know about technical analysis. Fundamental analysis mainly based on the deal on news. They study the economic data, interest rate, and the news. What the news are saying. What is the US government talking about? Is the dollar getting weak? Is the dollar getting stronger? Is the US economy getting stronger? You can use all those things, all those information, you can use them to trade. You can search, you can make research about it and use those information to actually trade with those informations. So that is how fundamental works. Fundamentals, you don't have to come to the chart to analyze. All you have to do is, after maybe getting the necessary information that you needed to get, is just for you to pick up your phone, go to your MetaTrader, pick up a buy if it's a buy, or you pick up a sell if it's a sell. We also have technical analysis. Technical analysis, that is what I do. I am a technical analysis. I trade technical analysis. I don't do much of fundamental, but sometimes I do fundamental, But I love technical analysis. You use the chart pattern, uses chart pattern indicators to forecast price. You analyze. You use indicators if you want to use that, but I don't use indicator. I'm not saying that indicators are bad. I will also be teaching on that indicators, but I don't use any indicator. I don't use indicators because some of those indicators lag behind. They only play after price has done what it wants to do. So most of those indicators lag behind. So I don't personally use indicators, but sometimes I might use some of the indicators like the bullying band and the stochastic oscillators. I can use most of those indicators. Sometimes I use them as a confluence to my trading. I use them as a confluence to my trading to check if what I'm doing is right. I also use them sometimes, but not all the time. But my percentage of me using indicators are always very, very low. Understand? I use them sometimes, but not all the time. So we also have chart pattern. We have patterns. You can also trade patterns, also included in fundamental. We have double top. In patterns, we have double top. We have double bottom. We have head and shoulder. We have falling wedge. We have a lot of patterns in the market, whereby whenever you see market forming that pattern, you can easily pick a trade, and boom, you can make a whole lot of money from any of those patterns that I'm telling you about, if actually you know how to trade it. So that is how it is. We'll be talking further and more about this technical analysis in our next episode on this our basic course on how to know, and also knowing how Forex works. We'll be talking more about this technical analysis in our next class that will be coming forth. So I think this will be all for today. This will be all for today. Thank you guys for staying to the end.